Welcome to A Few Minutes with Peter Grandich. I'm your host, Al O'Grady, and for the next few minutes, we'll be talking to Peter, getting his insights on the markets, commodities, business, politics, sports, and life in general. Peter Grandich is the editor of the Grandich Letter, which was first published back in 1984. He has been a market strategist, a portfolio manager of 4 hedge funds, a mutual fund that bared his name, and is widely known for his accurate forecasts and no-hedge markets perspective. He appears regularly on television and radio and is widely quoted in leading financial publications. He's also the co-founder and managing member of Trinity Financial Sports and Entertainment Management Company, an insurance and real estate planning firm specializing in servicing professional athletes and entertainers. Peter, as always, welcome back to the program.
Thank you, Al.
Okay, let's get right into this, and let's start with the stock market. You've said constantly that it would be a mistake to short the market, and it comes as no surprise to see that the market eking out a marginal new all-time high this year. But at the same time, you never really considered yourself a bull either. So can you explain this?
Well, yeah, I've always believed that there's been a mistake certainly among the investment community, but I know why, because it's a sales organization, but among investors, to have a sense that they always have to be long or short something, that being out of a market is not the way to go. And when you hear about people's pitfalls in markets, almost all the times those people say, if I had done nothing versus what I did, I would have been better off. And so while many people, I can't tell you how many, kept telling me that I'm making a big mistake and gave me a whole bunch of reasons why the market's going to come down hard, particularly those from the hard asset camp, because they tend to always be against the markets. It was my view that because of the don't worry, be happy crowd and their pent-up demand that's always money flowing into stocks or bonds, and the market, I thought, could actually go higher and not lower, but not to the extent that I would want to start owning a large-scale general U.S. equity portfolio for the years to come. And that marginal new high is still quite possible, but it would be so marginal. And if you look at from the last time it made the high, how many years ago, the net effect was if you were long general equities, you really didn't make much money, that you just don't want to be too caught up in general equities. But at the same time, making constant bets, and that's where, if you look at some of the perma-bears on the equity markets who looked a little bit right in 2007 and 8, but stayed with those positions, any gains they might have had have evaporated and now are looking up substantial losses. So I don't have a problem being neither long or short, but I do think sometimes it's not what you do, it's what you don't do that makes a difference at the end of the day, whether you're going to make money or not.
So having said that, just as actually a two-part follow-up, first of all, are you surprised that we've had a marginal new high nonetheless? Second of all, where do you see the markets going short-term, 6 months, a year, and even longer-term, 3-5 years down the road?
Well, we don't have the new high yet. It's something that I'm looking for. We've certainly gone a little bit higher than we might have been several months ago, but the new high would be 14,000 and change in the Dow, and I forget the number on the S&P. I still think it's quite possible, and part of the reason I think it's possible is because there's a sense of people that if it's not going down, then it could only go up. The other problem that's generated in this business now that didn't exist 20, 30 years ago, you talk about starting back in 1984. When I started back in a broker in 1984, I think the number was something like 85% of the trading on the New York Stock Exchange was individuals. And now I think it's something like 90% institutional. There's a much more pressure and much more short-term oriented performance barriers that managers face. And one of the things that happens is when markets start to go against their overall performance, they're almost forced in or out of markets because they're going to be judged on quarterly basis, and money flows in and out of the various funds that they're managing will change because of that. And one of the things that's happened here is, despite an overall gloomy assessment, the market is higher versus lower, and those who have avoided it or stayed out are facing some serious underperformance. And again, going back to Wall Street being a sales organization, once we get through September and we get into this final quarter, you're looking at many fund managers, and especially hedge fund managers, whose whole pay for the year is based on their year performance. And so if they're down 2 or 3% for the year, and they're facing a quarter and it looks like the market's going higher, they may be forced into the market so they could have a positive return so they could actually make money this year. Remember now, hedge funds have become one of the dominating players in the market, and their payout is basically based on profits. So it's, with most of them, the majority, I remember in the last quarter, were under the water, and the market's going higher. They may be forced into the stock market whether they like it or not.
Okay. The first part of your answer, another follow-up, do you find that it's more of a subjective thing that's really driving the markets as opposed to a fundamental? What I'm getting at is this. Do you find it's more confidence in the general public that can actually be driving the market higher versus the fundamental performance?
I think we make the mistake to think that this is a very sophisticated and based on true fundamentals and what might have existed 40 or 50 years ago. I think this is one big casino game now. It's tilted highly against investors. Not a week or so goes by where something, of some group being shown that they've been manipulating or taking advantage of markets. I really personally think individuals are so up against it, they no sense but the old saying, they don't have a Chinaman's chance. And I always wonder where they meant Chinaman's chance. I don't know what that actually means. But
we'll Google that one.
That when we're done. But the bottom line is, I really think a lot of fundamentals have been thrown out the door, and this is just one huge casino. Eventually, that is going to turn things really bad because it can't stay that way. There's only so much. I don't want to say illegal, but there are some illegal things, but things that aren't of the norm happen before you have another crisis of a proportional state. But having said that, I do think people today are asking themselves, did I miss it? Especially once you get that within 5%, so another 5% gain from here, you could start to make arguments that the target of a new high is in reach, and that kind of fuels itself. So it could be a somewhat of a perfect storm that the fourth quarter has a rally. There's probably two caveats in that. The election, if there's some great upset or what's viewed as an upset, and then, of course, the Middle East. But outside of that, I still think the market has more chance of going higher than lower.
Okay, you touched on two things as far as politics goes, and we'll certainly get into both of those areas a little bit later in the program. Let's change our focus a little bit. A couple of months ago, you were calling U.S. bonds the worst investment for the next 10 years. I think the 10-year U.S. Treasury bond was yielding only 1.44% when you suggested going short. What's the latest? Have bonds actually topped, or what's going on?
You would think so. I had hoped that we can get as low as 1.25% because I thought that would be, when you send everything in on the short side. But like I said at that point, it just didn't make any sense to accept a yield of less than 1.5% when we already know inflation's above that. So unlike stocks where something can happen and a company could invent a new product or a service is so wonderful and people pay multiple times for your shares what you paid, buying a bond at 1.5%, realistically the only real possibility of large-scale capital gain was if somehow interest rates dropped to 0.75 and you'd have a paper gain on that bond. But when you know you're supposed to be holding it for maturity, and in this case it was 10 years, and if inflation averages 2.5% or 3%, which it basically has averaged, and a lot of us think it's a lot more than that, but government statistics, and you're only getting 1.5%, the net effect is you will be a loser holding that. The funny thing is, you ask investors what's much safer, they'll tell you bonds over stocks, but bonds have been a horrific investment outside of this last 20 years for long-term investors. Stocks have outperformed them. And this uniqueness of artificially low interest rates made that an aberration, but I just didn't see how anybody would want something that's paying 1.5% when cost of living is at least twice that. So that's why, I continue to believe that they're the worst possible thing anybody could do for the next 10 years.
Yeah, I don't think we need a follow-up on that one. That's pretty plain as day, I think. It seems that everyone and his mother is bearish on the euro, and for good reason. The fact that the euro is a big part of the U.S. dollar index, that index itself has not managed to rise above a key resistance in that 83 to 84 area. Is that counter-trend rally, as far as the U.S. dollar index is concerned, is that counter-trend rally, is it now over?
Yeah, I've said all along that all we are witnessing in the so-called dollar is a dead cat bounce. When you look at, first of all, let's look at the U.S. dollar index. It's probably not the best index to look at the dollar because the euro is its single largest component. It's not evenly weighted. The Morgan Stanley trade-weighted index is a better one, and that's still in a decline because it takes into effect the same amount, the yen and other currencies, versus the euro. But think about this. All you've heard now for months, if not the last couple of years, is euro this and euro this and euro that, and Europe is going down the toilet, and these countries are going down and down and down. And the net result is the index, which fell from 120 down to 70, managed to bounce to 82, 83, and is already seemingly topped out there and starting to peter out to the downside. And despite all this, Europe is going out of business news. The euro is closer to turning around, and which I said now for a few weeks, if it gets above 1.25, we could have a massive short covering rally. So I just don't see any reason, to expect that the U.S. dollar is in anything other than the euro was more hated for the moment. But what we've seen in Europe, I've said now, is coming to the U.S., and when it finally hits here, our currency is really going to go in the tank. So the big surprise over the next few months is actually a rally in the euro, especially if we get over 1.25. And by the way, for those that may not know it, we had record short positions in the euro. In fact, I saw a number of only 3% bulls on the euro, and that's just a contrarian's greatest dream. That when a boat is so full of dollar bulls, there's really nobody left to take the position. So I think we're setting up for a big short covering rally in the euro, and that's also going to aid gold as well.
Getting back to the euro for a second, Greece has been in the news for a while now, and of course they've had their financial problems. If something catastrophic would have happened, wouldn't it have happened by now?
Well, my personal opinion is Greece will get out of the euro. I think sometime in the spring of next year, when it's recognized that for whatever reasons, and it's those choices of those people, that they don't want to take the austerity messages that the people who are the lenders believe they need to, they will have no choice but to be out of the euro. I think that could be a watershed event, and any short-term negative that would be, I think suddenly the perception will be, well, without Greece there, the other countries are worth saving, and I think there could be a rally of strong proportions. But that's just my speculation. But I think what you're more onto is this. We've had so much negative talk, and for so long, and I believe the markets have started to discount it to great extent. So if you get any positive news or news that wasn't perceived, and that's what I'm saying, when you got 90-something% of people bullish on the dollar, just the slightest news that the euro is not about to collapse is going to set up a tremendous short covering rally, and I think we're on the threshold. It's trading like it wants to. So again, watch 125 on the euro, a close above that, and I think there's a very quick rally to 130, 135, and it'll have an impact on the markets, but none more so than in the gold market in a positive way.
Okay, so you just mentioned gold. Let's talk about gold now. Lately watching gold is almost like watching paint dry. The range certainly remains tight, and neither the bulls nor the bears really can claim victory. Is this the new normal for gold?
No, my argument, and my nemesis likes to make fun of it. He's the only one. My mother of all bull markets comment is still intact. Think about this. Did you ever imagine in your years in and around this business, Al, that something can go up for 12 straight years in a row? And not only still do most people not participate in it, but anytime they basically talk about it, they frown about it. And that's the story of gold. It's had 12 straight years up, and still most people, excuse the pun, pan it. And it's just an amazing phenomena. And what I really think has happened is we had a key intermediate correction that began last September after we briefly got about 1900. We corrected the excesses that were in the market. We built a tremendous base, and if you really look at gold in the last 6 months, you'll see that it's making, albeit slowly, which is actually good longer term because it's a bigger foundation to go off of. It's having a series of higher lows. You know, we would first trade down to 1525, 1530 and bounce, then 1550, 1560, then 1575. Now they can't really, despite some raids that happen from time to time, they can't keep it below 1600. And that magical number remains 1650 if and when, and I think it's when, we get 2 consecutive closes above 1650, we're off to the races again. So I like the way it's trading. I think, technically it's really coming into its own. And let's not forget something I think we spoke about last time. We're just about to enter a seasonally favorable period for gold when jewelry fabricators return back in early September and do most of the largest percentage of their business in sale of jewelry, which is still an important component to gold between the months of September and December. So all in all, I think everything is shaping up very well, and I remain extremely positive about the future for gold.
You know, Peter, you stole my thunder because I had a great follow-up question. As you well know, I'm very much into technical analysis. In the last 2 months or so, it really seems that the price of gold, if you take a look at it, it has that rising bottom and it has that triangular wedge. And with chart patterns, the more decisive that they are, the more truth that there is to it. So in my humble opinion, in the next couple of weeks, you see gold passing that 1650 on volume. It can really take off. And I just wanted really you to, pardon me, for you to comment on the technical analysis end of things. I guess how much faith do you put in technical analysis and really in terms of future projections? But I think you're seeing the same thing that I'm seeing in terms of that rising bottom, that triangular wedge, and it can really shoot through that 1650 barrier.
Well, I like technicals for aiding an opinion or trying to get confirmation. In the end, I don't like it for the hour to hour and, the gambling aspect that people use it for. But longer term, I'm one that still uses a very old-fashioned and not used by most people, and younger people don't even know when you say it what the heck it means, but I use still Gann angles as my technical tool. But you're right. We are witnessing that not only in gold, but in silver. And these are markets that are setting up very strong foundations. So when they do take out resistance, they can run. And I think the run will be minimally back to the old highs that we saw last year. And I still believe that a 2 in front of the number, meaning 2,000, is only a question of when, not if. So as painful as it's been, and of course how dreadfully painful it's been because the junior resource market collapsed for reasons still today that I don't know why, but the recovery can be aided by a renewed sharp rise in gold, and I think that we're going to see that in the fourth quarter.
Okay, you touched on silver. Did you want to go into more detail regarding silver and also copper for that matter?
Well, people don't like when I say it, but I don't get anywhere as excited about silver to the level gold does. There are so-called silver bugs out there, but I still think it's a kissing cousin only to gold. It's really more of a base metal, but because of the relationship, it gets to play tag, and sometimes it gets the lead. But I, too, think that it's been in a constructive correction formation that's pretty well ending, and it, is ready to move higher again. And so if and when gold breaks above 1650, I think we'll start to see silver get up to, to the high 3 numbers where $35 or $38 becomes realistic.
Okay. I'd like to talk a little bit about current events, but before we do, we'll stay with that the resource theme. Your overall take on the junior resource market right now, Peter?
The only good news is the worst of the worst is over. It is, like I just said a couple of moments ago, still befuddling to understand why there was such a collapse in prices when metal prices themselves, general equities and economies didn't come anywhere close to that. But it is what it is. But I think the worst is behind us. But there's been people for months claiming we would have a rocket back up, and I said no, I think it'd be more like an L. And part of that is because as we do get somewhat recovering prices, people, particularly individuals who've been so beaten over this mentally and financially, just to alleviate what they view as pain, will take any bounces and move out and get set for next year. I don't think it's so much tax loss selling, because if you don't have a tax loss by now, you just won't. But I do think it's a throwing in the towel effect, and almost all retail investors I know, and many professionals, invest with a calendar year mentality, meaning January 1 to December 31st. And so as we get closer, you can see people start to think about next year already. And December is always a useless month, so we effectively have 3 more months in the market. I think the only thing that could change it and cause it to really rise more than 10% or so and be something much more than a bounce would be if gold really took off and suddenly, rallied $100, $150 in a few weeks. That could be something that could move that market. The problem we have there, and the individuals don't see this as much, but I see it because I still talk to the financiers and the people needing it. 90% of juniors probably have 6 months or less of operational cash, and that's certainly down to that now. And so now their share prices are much lower, so the amount of shares they would have to issue to keep funding their projects is much more. The financiers know that. They know they're in the driver's seat. So I still just think it's a very difficult time, and the sooner we get to January 1, 2013, the better, all things being equal, will be for the junior resource market. So worst is over, but don't see any dramatic changes unless we get, for some reason, a big, big pop in the gold price. Okay.
Let's change gears and talk about world politics. Peter, you certainly feel that the war drums seem to be beating with Iran and Israel. Is that tension factored in right now in the world price of oil?
I think it's helped bounce of late. Every day now Iran is talking about annihilating Israel, and stories are coming out of Israel to be prepared for a war, and a quick one, and that there's a window they feel may be closing, that if they don't act, it'd be more difficult for the United States to be involved a few months from now. I think initially, in the first hours and days, there's a big pop because all the talk and the pictures will be shown about the Strait of Hormuz and how much oil comes from where and there, and all of Israel's enemies will be taught, sending missiles into Israel, and Israel will be counterattacking, and I don't know what the United States role will be, if any. Then I think when people see it, there isn't a total collapse and supplies are still plentiful, there'll be a little bit of a retreat in that spike up. But then it will all be how this plays out politically after that before anyone can make a decision. What I think it has done is it allowed the correction in oil to run its course. And, you see it right away in the gasoline prices. As soon as the oil price ticked up, the gasoline prices came back up, strongly. And again, economists tell you, just 10 cents at the pump more what it does, knocks out GDP strength at a time when the U.S. economy at best is just waddling along. So I think, we'll see $100 oil again, and with any type of conflict, we'll see a $20, $30 possibly price added, then a pullback, and then we'll have to see how things play out politically after that.
Okay. Can't let this one go. This past weekend, Mitt Romney named Paul Ryan as his running mate. Your thoughts on that?
Well, apparently from some emails I still PO people when I say this, but I think the most happiest man in the United States that Obama's president is Jimmy Carter, because Carter is no longer viewed as the worst president that the United States has ever had in a modern era. But for whatever reason, people still feel it's 50-50 whether he'll be the president again. I do know this, and I say this from the heart, and this wasn't rehearsed. You have no idea I'm saying this. After listening to Joe Biden these last couple weeks, I pray to God that if some reason Obama is elected again, he remains healthy and Biden is never sworn in as president. The man really, really scares me. I think he's lost it totally, and I'd be very concerned if he was president, which I think can have an impact because I think that'll be some of the points made that, the old story, one bullet away, that Ryan would be a much better person replacing Romney than Biden will be over Obama. I think Ryan is a man for the time, but I don't think people's ready for it. I think he's faced up and sobered up to the fact of how bad we are in this country, something I've been writing about and others had, and that the things that have to happen in entitlement, I think it can be political suicide, but I think he's had the guts to talk about it, and we'll have to see whether or not people are prepared to accept that. Because, as I told you, the entitlement issue in America is what we're going to face the most challenge in. And the longer we wait, the more difficulties those decisions will have to be. So net, I actually think he was a pretty good choice for Romney because I think he's a much better speaker than Romney. But I'm personally still amazed that, a little bit somewhere on either side of 50% after how poorly Obama has done. And I never say that all the problems started with Obama's watch. These are both parties' faults. But if you just look at all the things the guy said he would do in his first campaign and how they failed, I don't know how you justify 4 more years of that. I mean, one of the things that I think he got in on was people were just tired and felt that Bush had let them down in a big way in his last years. Well, I think Obama, and you can even read it in his most strongest follows, have let down his followers and have not come through. And then I think the big argument, and this is probably my biggest pet peeve, I believe he's a big-time socialist, and I think these comments that he makes about the government's responsible for your success, not your own, and sharing the wealth, given a second term where he doesn't have to worry about running again, if you're really concerned about those issues that I am, I think he'll be going crazy to do more and more of that. So my view is I just hope Ryan is good enough and to somewhat change the direction. But I want to make this caveat, so if I didn't get any hate emails by what I just said, I'll certainly get them after this. Even if Romney wins, I don't think he's a savior. I don't think any one person or one party is a savior, that this horrible time that's coming to America, which has already been previewed in Europe, is coming no matter who wins. Only Romney's win pulls it for a few years versus Obama accelerates it and makes it happen faster.
2 thoughts I have regarding Paul Ryan. I think he's going to be coming under tremendous fire in the next week or two by the Democrats with his position regarding Medicare and Medicaid. And you mentioned an interesting point about Biden. I think a vice presidential debate between Ryan and Biden will be far more interesting than a presidential debate between Obama and Romney.
Yeah, I think it will be because people expect, them, especially Biden, could go off the handle. There is another thing that could happen here, and don't rule it out. We could see Biden step down because Democratic convention has not taken place yet and be replaced with somebody like Hillary Clinton. I mean, you have to be concerned. I don't care. You could be the strongest liberal Democrat. What this man has said in the last few days on different topics really, really concerns people. So, my personal opinion, I like him to stay because I think he's a net negative for the ticket. I think Hillary Clinton coming in as vice president could actually take Obama over the top and actually bring him victory. But I don't think she's prepared for that, nor do I think they get along. But it is something that's still a possibility.
That's an interesting point. I think that's a very interesting point because regardless if that does happen, I mean, Hillary will certainly be the Democratic candidate, I think, in 2016. So.
Oh, no, there's no question she wants to run for president.
Oh, exactly. Okay, that's it as far as politics goes. Let's go back to business just for a second. Any individual companies on your radar that you'd like to talk about before we go?
Well, today there was a bit of good news for a change. Alderon Iron Ore basically noted that their deal with the big Chinese steel company has been restructured very minimally and is set to close in a few days. I think that's very bullish. I think those who started claiming it was a short several weeks ago are going to get really squeezed hard. One thing, it's been a long time, but there's really an exciting early-stage potential world-class exploration program about to start through North American Nickel in Greenland. It's been a long time since a company or a play that I've seen where a few drill holes could identify a world-class discovery, and that's about to start. And then I just think, and you can throw darts at these things, but there are so many companies now whose stock prices have gotten to levels that have tossed out all real valuations. Case in point, a few days ago I had a chance to get an update on Orman, OLE, that announced last December that it was a merger potential talks. Still notes that publicly. It sounds like to me that once these resource updates come in the next couple of weeks, that might be one of the things that was needed to get this deal done so people can have an updated valuation and make judgments. And I just think we're going to see a lot of mergers and acquisitions in the junior market in the next 6 months.
Okay, Peter, every time we do our discussion, we talk about individual companies that you like to talk about. This past time, you did not mention Sunridge Gold. The only reason that I'm mentioning this is this past week, for the sake of our listening audience, I just did an interview with Mr. Michael Hopley, President and CEO of Sunridge. So I invite our audience to check out my website, corporateinterviews.com. And I believe we can also post that interview on your website as well. Is that correct, Peter?
Yeah, that'd be great. I didn't know you actually did that. And there's a classic example of the story I just said, a company whose net asset value is far more than its total current market cap right now. Probably its biggest danger the company faces is potentially being acquired for a valuation not close to what it really should be, but obviously much higher than where it's currently at. But yeah, I look forward to hearing that, and I will obviously post it as soon as we get done.
Okay, fair enough. One last closing thought. Is there some football team that's been practicing, maybe getting ready for the exhibition season? Is there any football team that you're kind of following at all, Peter?
Well, there's, I think, opening night there's a game. Some team that years and years ago were pretty good, but really have stunk up the joint for the last 10 years with a quarterback that's very overrated, playing the Super Bowl champions, I think, on opening night or something.
Something like that. I just thought I'd mention that because I think the team that you follow really needs to practice, Peter. They really do need to practice.
Yeah, well, I guess they've been too caught up staring at that Super Bowl ring, and, so...
Nowhere to go but down, Peter.
Oh, that's true. That's true. But, so they start off 1-0, and then they'll see what they go at.
Okay, all right. Another bet on that one, a medium double-double.
Okay.
On that note, Peter, as always, thanks very much for your time, and I look forward to talking with you again, I would think, in 2 weeks' time.
Thank you, Al.
Okay. This interview appears on my website, corporateinterviews.com. It can also be accessed on YouTube and iTunes. Just type in Grandich in those respective search engines to not only access this interview, but interviews that we've done in the past. If you have any questions for Peter, by all means, send me an email. My email address, very simply, al@corporateinterviews.com. We'll certainly do our best to mention it on our next program. For Peter Grandich, I'm Al O'Grady. Thanks very much for joining us.